Hello, this is Rochelle Agatha, and this is a lecture on normal balance, debits and credits, and we're going to cover T accounts a little bit too. So what you see before you is the accounting equation, and we talk about assets equal liabilities plus owner's equity. It's referred to as equity. In a nonprofit world, it's considered net assets. Assets are a debit, liabilities are a credit, and equity is a credit. So everything on the left side of the equal sign is the debit, the right side's the credits. When you increase an asset, it's a debit, so the debit has the plus sign. When you decrease an asset, a credit has a minus sign. If you are in a credit account, like a liability or an equity, a credit is a positive because the natural normal sign of a liability is a credit. And a debit would be a minus because the normal sign of a liability is a credit, so the opposite is debit. So let's do a little example. Let's assume you purchase supplies on credit for $500. So credit means accounts payable. So you debit supplies. So supplies are an asset in this example. So it's a debit and it increases. The debit goes on the left side of the T account. And then accounts payable is a credit. It's a liability. So you increase accounts payable by putting 500. And then the second transaction, let's say you made a payment on your account for $50. So you're going to decrease your cash. You started with $250 of a debit. Cash is an asset. So you decrease your cash by crediting. Notice it's a credit, decrease is an asset. And then you decrease your accounts payable because you paid your debt down by $50. So accounts payable is a liability. And if you decrease a liability, you're debiting it and you're going to reduce it. So when all said and done, this is a really simple example. Your T account has your debit on the right, your credit on the left, and you take your debits minus your credits, and you get your ending balance. So here is cash. It's a normal balance of a debit because it's an asset. It has a balance of 200 after these two transactions. Accounts payable is a liability. It is a normal balance of a credit. So it had a credit transaction, a debit transaction, and it has a credit balance of $450. And then supplies, you just bought supplies of 500 and it has a debit of 500. So my accounting equation is in balance because I have a $200 of cash and I have 450 of accounts payable, and then I have 500 of supplies. So right here, with just these little transactions, they balance within themselves. So I'm going to show you a little T account example. So you can see assets equal liabilities plus equity. Assets are a debit, liabilities are a credit, equity is a credit. And then you will learn about revenue and expense. So revenue minus expense is net income or loss, depending on if your revenue is bigger than your expenses. So revenue is a credit account. Expense is a debit account, and net income will be a credit if it's income, and it will be a debit if it's a net loss. And I show you here what happens to equity. Equity increases or decreases in a simple world based on revenue and expense. So notice equity is a credit account. So if revenue comes in and is closed out through equity, it increases equity. And then expense closes out through equity and it decreases equity. So once again, this shows you what I mentioned earlier, that if you have net income, that increases equity. And if you have net loss, let's put this net loss, it will decrease equity. So it's a pretty high level overview, but it's a good way to remember the accounting equation, the normal balance of the types of accounts, and then to visit it as a T account. T accounts are the best way to do accounting. If you have any questions, send me an email. Thank you.